March 6, 2026 opened with silver futures at $106.80. By 10:15 a.m., prices had spiked to $118.40, an $11 move in 2 hours. Then at 10:47 a.m., the Chicago Mercantile Exchange issued an emergency notice. COMEX silver trading halted for 15 minutes due to circuit breakers triggered by extreme volatility. When trading resumed at 11:02 a.m., silver touched $124.90 before violent selling drove prices down to $112.30 in 23 minutes. The intraday range was $18.60, over 15% from low to high. This wasn't normal volatility. This was a short squeeze so violent that it broke the exchange's risk management systems and crushed traders on both sides of the market. Let me walk through the exact sequence of events on March 6th that created the most violent price action in silver market history. Understanding the timeline reveals why shorts got absolutely crushed. Silver futures closed at $107.80 on March 5th after the massive rally following bank exit announcements. Overnight trading in Asian hours was relatively quiet, with prices drifting slightly higher to $108.20 by 5 a.m. Eastern Time. European trading brought more aggressive buying. By the time U.S. markets opened at 8:20 a.m., March silver futures were already at $111.40, up $360 from the previous close. The overnight move suggested strong buying interest from European and Middle Eastern buyers. U.S. trading opened with immediate heavy volume. In the first minute, over 2,800 contracts traded, virtually all at the ask price, indicating aggressive buying. Prices jumped from $111.40 to $112.80 in the first 60 seconds of trading. The buying pressure continued relentlessly. By 9 a.m., silver had climbed to $114.60. By 9:30 a.m., it reached $116.20. The rally showed no signs of pausing or consolidating. Every small dip was immediately bought, pushing prices higher. At 10:15 a.m., March silver futures traded at $118.40. At this point, silver was up $10.60 or 9.8% from the previous day's close. This was already the largest single-day percentage gain since Friday the 13th, when the crisis first became visible to mainstream markets. But the real violence was just beginning. Between 10:15 a.m. and 10:47 a.m., silver went vertical. The rally accelerated, with prices jumping $1 to $2 every few minutes. By 10:40 a.m., silver touched $123.50. By 10:45 a.m., it reached $124.70. At 10:47 a.m., it spiked to $124.90. This $650 rally in 32 minutes was driven by what traders call a gamma squeeze in the options market, combined with forced liquidation of short positions. Let me explain the mechanics. Silver call options with strike prices of $120 and $125 had been heavily sold by market makers and some speculative traders who thought those prices were unreachable. These sellers were short gamma, meaning as prices approached the strike prices, they had to buy futures to hedge their exposure. When silver crossed $120, market makers who had sold 120 strike calls needed to buy thousands of futures contracts to hedge. This buying pushed prices toward $125, which triggered hedging, buying from 125 strike call sellers. The hedging buying created a self-reinforcing loop, pushing prices higher in minutes. Simultaneously, traders who had shorted silver futures at $95, $100, or $105 were facing catastrophic losses. Someone short from $100 was now looking at 24-point losses, or $120,000 per contract. Many couldn't sustain those losses and were forced to cover their shorts by buying, which added more buying pressure. At 10:47 a.m., the CME's automated risk management systems detected that silver futures had moved more than 15% in a single session. This triggered a mandatory circuit breaker, halting trading for 15 minutes to allow the market to stabilize. The halt lasted from 10:47 a.m. to 11:02 a.m. During the halt, participants couldn't trade, but they could cancel or modify orders. Many buy orders were canceled during the halt as buyers decided $124 silver was too expensive. Some short sellers used the halt to arrange additional margin funding to avoid forced liquidation. When trading resumed at 11:02 a.m., the first trade executed at $124.20, but within seconds, massive selling hit the market. Someone, possibly a large fund or institutional trader, decided to take profits on the entire rally by selling thousands of contracts at market. The selling was so aggressive that prices gapped down. Silver traded $124.20, then $121.80, then $119.40, then $116.90 in a matter of seconds. The order book was so thin after the circuit breaker halt that sell orders walked straight through multiple price levels without finding buyers. By 11:07 a.m., just 5 minutes after trading resumed, silver had fallen to $114.60. That's a $9.60 decline in 5 minutes, erasing over 3/4 of the morning's gains. Traders who bought at $122 to $124 during the spike were suddenly underwater by $8 to $10 per contract. The decline continued to 11:25 a.m. when silver touched an intraday low of $112.30. From the high of $124.90 to the low of $112.30 is a $12.60 range in just 38 minutes. This kind of volatility is almost unprecedented in commodity futures markets. Then the buying returned. From 11:25 a.m. to 12:30 p.m., silver rallied back to $117.80 as buyers decided the pullback was a buying opportunity. From 12:30 p.m. to the 2:30 p.m. close, prices chopped between $116.40 and $118.60 before settling at $117.20. The final settlement of $117.20 represented a gain of $9.40 or 8.7% from the previous close. Under normal circumstances, an 8.7% gain would be considered massive. But after the intraday violence that saw an $18.60 range, the final settlement felt almost anticlimactic. Now let me explain exactly who got crushed during March 6th's violent reversal and the mechanisms that destroyed their positions. The casualties extended across multiple types of market participants. The most obvious victims were traders who were short silver futures from lower levels. Anyone who had sold silver short at $90, $95, $100, or $105 and held those positions through March 6th faced devastating losses. A trader short from $100 saw their loss expand from $18.40 per contract at the March 5th close to $24.90 at the March 6th high. That's an additional $650 loss in 2 hours or $32,500 per contract. Someone short 100 contracts was suddenly looking at $3.25 million in additional losses in a single morning. Many of these shorts were forced to cover. Their brokers issued margin calls that couldn't be met, triggering automatic liquidation. The forced covering buying contributed to the spike to $124.90, and the shorts who covered at or near the high locked in maximum losses. But there's an even more tragic category: traders who went short during the rally thinking it was overextended. Some traders saw silver at $115 or $118 and thought it was obviously too high given that silver was at $84 just 2 weeks earlier. They shorted, expecting a quick correction. These traders got obliterated. Someone who shorted at $118 thinking it was the top watched in horror as prices spiked to $124.90 within minutes. That's a $6.90 loss per contract, or $34,500 per contract, in less than half an hour. And they had no opportunity to exit because the market was moving too fast and liquidity disappeared. Option sellers also got crushed, particularly those who sold call options naked without owning the underlying futures. A trader who sold March 120 calls for $2 when silver was at $105 thought they were collecting easy premium on options that would expire worthless. When silver touched $124.90, those 120 calls were worth approximately $5.50, a $3.50 loss per option. Since each option contract represents 5,000 ounces, that's a $17,500 loss per option sold. A trader who sold 20 contracts thinking they were safe was suddenly facing $350,000 in losses. Worse, option sellers have gamma risk that accelerates their losses as prices move against them. They're forced to hedge by buying futures, which pushes prices higher, which increases their losses and requires more hedging buying. It's a death spiral that trapped many option sellers on March 6th. Even some bulls got crushed. Traders who bought silver at $122 to $124 during the spike, thinking the rally would continue to $130 or $135, were caught when the violent reversal hit. Within minutes of their purchase, they were underwater by $10 to $12 per contract. Many of these latecomers to the rally panicked and sold at or near the $112.30 low, locking in large losses. They bought the top and sold near the bottom, the worst possible execution. Some of these were retail traders using leveraged accounts who got margin, called on the reversal, and were forced out at terrible prices. Market makers and liquidity providers also suffered. These firms make money by buying at the bid and selling at the ask, capturing the spread. But during extreme volatility, spreads widen dramatically and markets can gap through price levels. During the most violent moments of March 6th trading, bid-ask spreads widened to 0.50 to $1 in silver futures. Normally spreads are 0.01 to $0.02. A market maker who bought at 123 ZER expecting to sell at 123.10 might have seen the market gap down to 121.50 before they could exit, creating a $1.50 loss instead of a $0.10 profit. Several proprietary trading firms that specialize in high-frequency market making reportedly suffered significant losses on March 6th and reduced their silver market participation afterward. When market makers withdraw, liquidity declines further, which makes volatility worse in a negative feedback loop. Brokers also face challenges. When clients can't meet margin calls, brokers must liquidate positions at whatever prices are available. During the March 6th chaos, some brokers had to liquidate client accounts at the worst possible prices simply because there was no choice. The clients lost money, and some brokers faced legal liability for the execution quality. Let me explain what March 6th's violent reversal reveals about the current state of silver market structure. The volatility isn't random chaos. It reflects fundamental structural problems that are getting worse. The liquidity crisis is the core issue. In normal markets, there are always buyers and sellers at various price levels. If someone wants to sell 1,000 contracts, they can do it without moving the market more than a few cents. But silver markets on March 6th showed virtually no liquidity during critical moments. When the reversal hit at 11:02 a.m., there were almost no buy orders between $124 and $119. Sellers had to keep lowering prices until they found buyers willing to take the other side. This created the $5 gap down in seconds. That should never happen in a well-functioning market. Why is liquidity so poor? Because the major banks that used to provide liquidity exited the market. JP Morgan, HSBC, Scotia, and Standard Chartered were the largest market makers. They would buy when others wanted to sell and sell when others wanted to buy, keeping markets orderly. Without bank market making, the order book is thin. Small orders can move prices significantly. Large orders create chaos. And during panic moments, there's simply no one willing to provide liquidity at reasonable prices. The circuit breaker halt on March 6th revealed another structural problem. Circuit breakers are designed to pause trading during extreme moves, allowing participants to reassess. But in silver's case, the halt may have made volatility worse rather than better. During the halt, many buy orders were canceled. When trading resumed, there was a vacuum of demand that allowed sellers to push prices down violently. If trading had continued without a halt, some of those buy orders might have supported prices and prevented the sharp reversal. This suggests that traditional risk management tools designed for stable markets don't work well during supply crisis conditions. The CME may need to redesign circuit breakers or eliminate them entirely for markets experiencing fundamental supply shocks. The options market showed severe dysfunction on March 6th. Options implied volatility spiked to over 140% during the morning rally, then fell to 95% during the reversal, then rose back to 125% by the close. These wild swings in volatility measures indicate that options pricing models are breaking down. Options are priced using models that assume relatively stable volatility. When volatility itself becomes highly volatile, the models produce nonsensical results. Some options were mispriced by 30 to 50% during March 6th, creating arbitrage opportunities that sophisticated traders exploited while retail traders got crushed by bad pricing. The correlation between silver and other assets also broke down on March 6th. Normally, silver moves somewhat in line with gold, copper, and other metals. But on March 6th, gold was flat while silver was gyrating wildly. Copper actually fell slightly while silver spiked. This suggests silver is now trading on its own unique supply crisis dynamics rather than broader commodity trends. Traditional relationships and correlations that traders relied on for risk management no longer apply. Now let me explain what March 6th's violent reversal means for silver's path forward and what traders should expect in coming weeks. The violence provides important signals about market dynamics. First, the reversal proves that even during a severe supply crisis, sharp corrections can happen. Markets don't move straight up. When prices spike too far too fast, profit-taking and technical selling can create violent pullbacks, even if the fundamental situation hasn't changed. This means traders need to manage position sizing carefully and use stop losses strategically. The trader who bought at $122 during the spike didn't do anything fundamentally wrong. Silver's supply crisis is real. But their timing was poor, and their position sizing may have been too aggressive given the volatility. Second, the violent reversal likely shook out weak hands and weak shorts. Traders who were marginally committed to long or short positions probably exited during the chaos. What remains are stronger hands who are more committed to their positions. This creates a more stable base for the next move. If silver rallies from here, it will be supported by committed longs rather than momentum chasers. If it declines, it will face resistance from shorts who learned that fading the rally can be catastrophic. Third, the March 6th action attracted enormous attention from traders and investors who weren't previously watching silver. When a commodity moves 15% in a day with a circuit breaker halt, it makes headlines across financial media. This awareness will bring new participants into the market. Some new participants will be speculators attracted by volatility and profit potential. Others will be investors who now understand the supply crisis is real and want exposure. This expanding participation could drive the next leg higher. Fourth, the reversal demonstrated that physical markets and futures markets are completely disconnected. While futures spiked to 124.90 and then crashed to 112.30, physical dealers were quoting $145 to $155 for immediate delivery throughout the day, with minimal variation. Physical buyers weren't panicking about the futures reversal because they understand futures prices are increasingly irrelevant to physical supply and demand. This disconnect will continue widening, eventually rendering COMEX silver futures useless for price discovery. Fifth, the bank short covering is still happening. JP Morgan and other banks announced they would unwind positions over 30 to 60 days. March 6th was only day 2 or 3 of that process. There are still tens of thousands of contracts that need to be bought back over coming weeks. This creates a persistent bid under the market. Even if prices pull back in the short term, the bank covering buying will limit the downside and support the next rally attempt. The most likely path forward is consolidation for several days in a $110 to $120 range as the market digests March 6th's violence. Then another rally attempt toward $125 to $135 in mid to late March as bank covering continues and physical shortage intensifies. The key level to watch is $110 on the downside. If silver holds above 110 during any corrections, it confirms the bull trend remains intact. A break below 110 would suggest something more serious, possibly intervention by exchanges or governments to cool the market. On the upside, $125 is the next major resistance. Silver touched 124.90 briefly on March 6th but couldn't hold. A sustained break above 125 would target $135 to $145 as the next zone. For investors and traders, March 6th taught several lessons. Don't chase spikes. Wait for pullbacks to enter positions. Use proper position sizing so you can withstand violent moves without being forced out. Recognize that volatility will remain extreme and plan accordingly. Most importantly, understand that the violent reversal doesn't change the fundamental supply shortage. China still banned exports. Mexico still nationalized concentrates. Banks still exited their shorts. Physical premiums are still $25 to $35 over futures. The supply crisis is real and ongoing. The path to resolution won't be smooth. There will be violent rallies and violent reversals. But the overall trajectory remains upward as long as physical supply cannot meet demand. Silver's violent reversal crushed shorts who bet against the supply crisis. It also crushed some late buying bulls who chased the spike. The survivors learned that in a market this volatile, risk management is everything. The next violent move could come at any time, and being positioned correctly while managing risk properly will separate winners from casualties in the most volatile commodity market in modern history.